Hi everyone, we're just waiting for a few more people to join in. Okay, welcome everybody, good afternoon. Welcome to B&M Care's funding webinar in association with our SOLLA Accredited Financial Advisors Eldercare Solutions. My name's Angela Hunt and I'm the Sales and Marketing Director for B&M Care Homes. A warm welcome to our existing families joining the webinar today, and also welcome to those of you out there stepping into the world of accessing long-term care for your loved ones and wading through the minefield that's finding ways to fund that care. B&M Care have been operating care homes for 50 years now, and we take the view that providers like us have a real responsibility to share our knowledge with our families as well as the wider community. So today's webinar is part of a series of discovery events that we deliver, which includes the in-person How to Live Well with Dementia and the virtual dementia tour. You can take a look at our website, bmcare.co.uk/events for any of our upcoming dates. So let's move on to today's event. I'm going to hand you over now to Nicky Cave from Eldercare Solutions, who's going to take you through today's care home funding webinar. Over to you, Nicky.
Thank you so much, Angela. Let me just quickly share my screen, which I hope will work. There we go. Hopefully everybody can see that and hear okay. The webinar is being recorded and that will be made available to you. Angela will share that as soon as I get it to her, which will either be by the end of today or certainly tomorrow morning latest, so that can be shared with family. And it also saves you having to write copious notes this afternoon because there will be a lot of content. I'll be talking for probably around 45 minutes or so, and because of the sheer volume of people we've had register for the event and log on, we're not really going to be able to handle sort of personal questions during the event. So hopefully as we go through, all the questions will be answered, but if not, my contact details will be displayed towards the end, and Angela can put you in touch with myself as well, or one of my team, and we can then help and answer any remaining questions that you have on a sort of bespoke basis. So we've decided to pick the topic of funding just because it is so confusing. That road sign, I think, reflects how most people feel when they're coming across this for the very first time. Obviously, people listening today will be in a range of places on that journey. Some might have not really thought about it at all yet. Some may have already had to deal with most of the journey, and their loved one may already be in a residential care setting. So I'm aiming this really at people that know nothing, people who perhaps are feeling confused and unsure, and hopefully will try and clarify the general issues around funding. I've broken the agenda down. It is very much focused at care homes as opposed to care at home, but actually quite a lot of this applies in both scenarios. So it seems like a straightforward question, who pays for a stay in a care home, but actually the answers can be quite confusing. So we'll try and work through that. Some of you may have heard about changes to the system. Indeed, an announcement that a certain ex-Prime Minister made on the doorsteps of Number 10. So I want to just clarify for you whether those changes are happening, what they might look like, and when that might happen. We'll touch very briefly on the family home, as I know this is an important topic for people. Does that family home have to be sold to pay for care? And then really in closing, we'll look at whether there are some legal solutions to preventing money running out when somebody's paying for care. Throughout the presentation, you'll see our website, separate to the B&M website, our website there, eldercaregroup.co.uk, and I'll put an email address and phone number at the end as well. And just before I start running through that agenda, which hopefully means you're on the right event, and hopefully they're the sorts of questions you were expecting or hoping to have answered, let me just do be polite and give you a more formal introduction to myself. So Eldercare, we are, as Angela said, a firm of Society of Later Life Accredited Independent Financial Advisors. What a mouthful. Really what that means is it's the gold standard. We have to be independently verified and accredited as knowing our stuff for the later life market. Now, that is quite a wide-ranging time frame, later life. What does that mean? To some people that's over 50, to some people that's over 60, over 70. We're actually very, very niche within the later life field in that we deal exclusively with advice on solutions for care fees funding. So we're very much at the point of need advice. I may have qualifications, as I do, in pensions and trusts advice and life assurance, but I haven't given advice in those areas for some 20 years. So don't listen to me when it comes to anything to do with pensions. However, every day for the last 20 odd years, me and my team have been advising on care funding. So we're very, very niche experts in that field. And the business is mine, set up by me back in its current format in 2007, simply because we went on this journey as a family with my grandparents and we got absolutely no advice. And I'm not blaming anybody for that. You don't know what you don't know. So we didn't tell anybody that we didn't know what we were doing. And everybody sort of assumed we knew what we were doing. We just sold the property, we spent the money. And, you know, luckily enough, the local authority picked up the tab. But if we had had the knowledge that I now have, we would have made different choices at the time. And there might actually even have been some money left over, as per my grandparents' wishes, to pass to the children. So this is all really me on my soapbox, sharing with you the information that I wish we had known back then. What you do with that information is entirely up to you. And whilst we're here at Angela and B&M Care's very kind invitation and organisation, we have no commercial links with them or any other care provider. This is just about getting the right information to the people that need it at the right time. No other ulterior motive at all. If we're having money conversations, which we are with families, it's important to note that we are properly regulated. So you will be able to find us listed on the FCA, the Financial Conduct Authority Register. Absolute must for anybody you're taking any financial advice from. And I am talking to you today from Hertfordshire, but with this technology, some of you may not be in Hertfordshire. You know, you could actually be in another country. That's the beauty of this, isn't it? We've picked up from sort of post-COVID times. We could never have this number of people on an event if it were held in one of the care homes, for example. So interestingly, even before COVID times, however, we were delivering our actual advice to families, usually remotely. Might have just been the old-fashioned telephone and email, but it was remote. And we were doing that basically to keep our costs down. If we weren't travelling to see people, we can deliver a much more efficient service from that perspective, cost. But also it meant that everything is in writing. If I'm emailing one of the daughters and she then can forward that to her siblings, everybody's seeing exactly the same information, and that doesn't happen if I were just to meet face to face with one of the family. So it's just something that's evolved for us, and it means that any initial consultation, any chat that we have with you on a remote basis is completely free of charge, at our expense and not yours. And as I say, we couldn't do that if we were having to factor in a couple of hours travel time to come and have a chat with you. So hopefully that works for everybody. It seems to be something we've all got a bit more used to. So moving back to the agenda, and as I say, some of you may already know a lot of this, but I have to start at a base level of many people may not know any of this at all. So it's a complex subject which I'm going to squeeze into a very short period of time. So of course there is more to it than I will cover today, but we'll do our best. We could take a fairly simplistic view if we were answering that question, who pays for a care home stay. Three options broadly. Somebody could be funded by the local authority, social services, the council. That's all the same place, we're just calling it different names. Somebody could be funded by our much loved National Health Service, or they are called a self-funder or a private fee payer is the other commonly used term. You can sometimes have some interaction between the three streams, but as I say, we're keeping it simple. So let's look at each in turn. And the first thing really to note about local authority funding, people in the main know that it is means tested and that your money matters as to whether you get local authority support. But I have to be clear with you that something should happen first. A care needs assessment should happen as the first step. So if I were considering for my auntie to go into a care home, she's on board with that. She's recently widowed. She thinks that she'd have more social interaction and some good care in a care home. We need to ask her local authority to carry out a care needs assessment. And if they don't agree that she needs to be going into a care home, then actually it kind of stops there. They're not going to be paying for her, you know, even if she's eligible for funding on paper. So you have to meet the local authority's eligibility criteria first. If you're just choosing to go into a care home and you subsequently ask them to fund you, or you ask them to fund you from the offset, they'll say no. The key is, though, that they should be doing this care needs assessment before they ask you about your money or the person's money. So it's care needs assessment first, and then a financial assessment or a means test second. Okay, really important, it's that order. Unfortunately, that isn't what seems to be happening at the moment. There's lots of questions asked first about how much money somebody has, and if they say they have over the threshold, the care needs assessment doesn't happen, and that's not right. Now, if we were all in a room together and I had a prize, I'm sure I'd be dishing it out to lots of people if I asked you, what is the capital limit? How much money does somebody have to have before they're eligible for local authority funding, assuming they meet the care needs criteria? Well, you'll be shouting this figure out, no doubt, 23,250. It hasn't changed for, I think, now 10 years. So in real terms, every year that has gone backwards. Now, people talk about the care in Scotland having a better system, and it's more generous there. It's only about £5,000 more in Scotland. It's actually at its most generous in Wales, where the capital limit is £50,000. And these figures are per person, so we can double them for a couple. Now, I'm going to talk in more detail about the change to the system that I think you'll have heard of, but there was also a change tabled and due to come in October next year. I'm not sure it will happen, but there was talk of that 23,250 going all the way up to £100,000. So somebody should be eligible for state support when their capital drops to 100,000. As I say, let's watch that space. And even somebody now who's eligible for local authority funding, they still have to contribute from their savings and their income, but they certainly have to contribute from their savings such that the 23,250 could even go as low as 14,250. Okay, so a lot of detail sits behind these headlines here, but the key one here, you have to meet the council's care needs criteria first, then have a chat about the money, and then funding is only made available if your assets are under that limit. Now, it's not, well, again, having to keep it simple, I could just say what counts as capital, everything, because it is practically everything that counts. But there are three exceptions that I just want to draw your attention to because they do affect quite a few people. The first is if you are part of a couple and only one of you is moving into a care home, it is only the individual moving into the care home whose capital can be assessed. So if there is joint savings, then half of those savings can be included. But the spouse at home, if they have money in their own account, solely owned account, that capital is not included in the means test. These are individual assessments, not the assessment of a couple. There's a really good Age UK fact sheet, which I can make available on request, that just talks very much about this and how it makes sense to actually equalise the estate just before someone's going into care. We're not depriving anybody of assets, we're not messing with the percentages, but you just make it clear who owns what. It makes things a lot tidier going forward. The property is also worth a mention because, again, in a couple scenario, lots of people worry that the person going into care person staying at home, that's at some point the local authority will come back and take some money against that property, sort of retrospectively. Now, that's not the case. If a spouse or relative over 60 who genuinely lives there remains living there, when somebody goes into care, that property is disregarded. It's not deferred, it's not retrospective, it is invisible for the entirety the person lives there. Now, if the spouse at home predeceases the spouse that's gone into care, then from the date of death, yes, the property then appears in the means test. If the spouse at home also moves into a care home, so we now have both people in a care home from that date, the property value is included in both their means tests. But otherwise, that property is invisible, and it doesn't matter whether it's owned as tenants in common, joint tenants, if it's owned by just one of them, it doesn't matter. The spouse living there makes it invisible, or the relative over 60 living there makes it invisible. So that's really important to be sure of, because it does cause a lot of worry. And the last of those three exceptions that I'll mention, not so common, but if somebody has got their wealth, their capital held in an investment bond that has a life insurance element attached to that investment bond, easy for us to spot, maybe not so much for you, but if it's companies like Aviva or Friends Provident or Standard Life, and as I say, it has life assurance, not a Barclays bond or an Abbey National bond, then the odds are that will be a disregarded asset. You can still choose to cash it in, you can still use the money, but the local authority wouldn't be able to include its value. Otherwise, unfortunately, your money under the bed, if anyone keeps it there, your premium bonds, your ISAs, your stocks and shares, your holiday homes, your second rental properties, all of that is treated as capital that has to be assessed in the means test. And it's really important to note that income counts as well. People sort of have an idea that the entry point is capital, but then they completely disregard or don't know that when the local authorities say how much they'll pay, they expect you to contribute your income towards that. Lots of families think that they can just sort of top up using the individual's pensions, and that's simply not how it works. Now, if we have a couple scenario again, then we're looking at the spouse at home can keep half of any private pension, but otherwise the other half and the state pension and any other income, as I say, that is looked at by the local authority and included when they work out who pays what. So you really literally don't get to keep anything other than a small personal expenses allowance. And it may come as no surprise to you, but if the local authority start to pay for somebody, they'll have a limit, a budget, they'll have a limit on what they will pay. And it may not be anywhere near the fee that if you went in as a private fee payer that you were agreeing to pay at the start. We have a sort of a cross-subsidy system simply because the local authorities do not pay enough. They need to pay more. Now, if you are local authority funded from the very beginning, the local authority is obliged to find a care home and fund a care home that meets your needs and that they pay for, as I say, in full, albeit you have to contribute your pension towards what they pay. But they can't just say, we'll pay £700, go and find somewhere that will take £700. There has to be an actual legitimate real life care home place that meets that person's needs that costs £700. And if there isn't, the local authority's got to pay more. So there must always be what we call a no top-up option. There must always be at least one of those on the table. If, however, you, the family, the individual, rejects that offer and says, well, thanks, but we don't like it, we prefer this one, in that scenario, a third party top-up can, of course, be requested by that alternative care home. But we must, as I have to repeat, there must always be a zero top-up option because not everybody has family or anyone that could pay a third party top-up. So you need to be clear on that. The other scenario where a third party top-up could be requested is if actually the individual starts off as a self-funder, chooses their own care home and then runs out of money. Depending when that happens, how far into the journey, what conversations took place with the care home up front, what does the care home contract say? Unless the local authority and the care home can come to an agreement on a fee, then the care home, in order for the individual to stay there, the care home may very well legitimately ask for a top-up to be paid. So these are conversations and bits and detail that really need to be ironed out at the beginning so that they don't come as a surprise, okay? But that, in a nutshell, is our means tested system. It's not going anywhere. It's been around for a very long time, our safety net system. As I say, the capital entry point, the limit figure may change next year. We'll wait and see. But it's not going anywhere. What might happen next year, October of next year, question mark from the skeptical me, a new system may come in, but this is an as well as system. This isn't replacing the one I've just outlined, our means tested system. This is something else, just to confuse us, that's going to run in parallel to the means tested system, or if it happens. And for some people, I'll go through this, how it's going to work. It just may not ever affect them, because long before they reach the care cap, their assets may have depleted and they qualify for that means tested support that I've just outlined. So this really doesn't benefit them. Some people may have so much wealth that actually they will reach this care cap and they will benefit from it. But I think I will evidence to you in a minute that they won't benefit as much as they thought they might. And then there's a whole group of people who are going to be somewhere in the middle who may or may not benefit from it. It all depends really how long their loved one is in care. What I can tell you with certainty about the care cap, the lifetime cap on care that Mr. Johnson announced, is that it will not be retrospective. Now, this should have come into play last year. This was all set up to happen in October 2023. In fact, it was actually set up to happen originally in 2016. It didn't, it was U-turned. Funnily enough, before the U-turn, it was delayed for a couple of years. This very much feels the road we're going down. It's been delayed for 2 years. I sense that as we get nearer to October 25, it may be U-turned again. And it's all down to cost. It's down to the fact that our system is under immense pressure. And this care cap system required an awful lot of input from social workers. They were suddenly have to assess everybody rather than just assessing people who were asking for means tested support. So you had all the work that needs to go on for means tested support, and then all the people that wanted to open up a care cap account were going to be knocking on the door asking to be assessed as well. And I think the services were just going to be overwhelmed. So we will have to wait and see. What I can also tell you about it is that the amount, this is the figure that might ring a bell, was set, the lifetime cap was set at £86,000. Of course, there are some buts, because what that says to most people is that if I just put £86,000 aside in my bank account and earmark that for care, I'll be fine, won't I? Because the cap has been set. I only have to spend 86,000 and then I don't have to spend any more. That's certainly how the media reported it. That's certainly how the headline grabs you. The reality, however, is that the way the clock will count up is that it will be the local authority rate of funding that counts, not what you are actually paying. And I'll give you an example of this in a minute so it becomes clearer. And also hotel costs won't count. So the good news is they've already said that the hotel costs won't have to be worked out individually by each care home. The government just has said hotel costs are £200 a week. So whatever you're spending on the care, take £200 off and the balance will count towards your cap, but at the local authority rate of care funding, not what you are paying. So let me show you this. And remember, this is being recorded, so you can watch this bit back because it is a lot of information, but it's an example that's as true to the reality as I can get, because I have used average fees from a survey across the country. And what that tells us is that if my auntie goes into the home of her choice as a self-funder, on average, she'll be paying £1,300 a week. But if she were to ask the local authority to pay for her because she's run out of money, on average, the local authority pays £600 a week. Big difference, as I mentioned earlier. So what counts towards my auntie's cap? It's the 600, not the 1,300. It's the 600 minus those hotel costs. So a meagre £400 a week is clocking up on her care cap account, even though she's physically spending £1,300 a week, some from her savings, some from her income. That's going to have a huge difference, a huge impact when somebody does the maths, because logically you'd think she might be eligible after about sort of 70 weeks, but oh no, if we divide the 86,000 by 400 weeks, that's nearly 4 years from when the clock starts ticking in October next year before she reaches the cap. So late 2029 will be the first bell ringers for reaching the cap. What happens when she reaches the cap? Well, as I say, she may well have run out of money before then, so she'll be means tested and have support from the local authority, as we outlined at the beginning. If, however, she started off with a lot of money and is still a self-funder at this point, so she actually has spent nearly £280,000, but let's say she still has 100,000 in the bank, does she stop having to pay? Of course not. She will still have to pay the 200 a week hotel costs, and she will still have to pay the top up, the difference between the local authority rate and the care home rate. So she's still going to have to pay £900 a week. What she'll get is a £400 a week bonus. She'll get given £400 a week instead of it just clocking up on the computer. So of course she'll be grateful to receive £400 a week towards her care. But if she was expecting to only have to spend 86,000, that's not really going to be much compensation. So my message really today to you, even if you don't understand any of that, is it may not happen. We may just be stuck with our means tested system, maybe with a higher entry point, and they'll abandon the cap altogether. I think my key takeaway message, if that does happen, is don't be too upset, because it really wasn't worth very much to you anyway. It really was smoke and mirrors. And I don't imagine it's going to get more generous as we get nearer to October 25, but you know, I hope I'm wrong. So that's the care cap, which may or may not happen, will sit running alongside our means tested system. And that's where we're at for the majority of people, I would suggest, who move into care homes. For the minority, and it really is a minority, there is some funding that would be available from our much loved National Health Service. Now, this is almost a webinar in itself, and I wouldn't be the person running it because I'm not an NHS funding expert. But again, there is an absolutely brilliant Age UK fact sheet, very detailed, that talks about this. But at a very basic level, I want to just say that NHS funding is available to anybody regardless of your wealth. So this is not means tested. But it has to be that the individual's primary care need is a healthcare need, as opposed to help with personal care or social care. So the sorts of conditions and illnesses, perhaps, and health where we would normally be treated in hospital, obviously we're not invoiced for that when we leave. So if people are having a similar level of care that you would have in hospital, but it's being provided in a residential care home, nursing home setting, the NHS still have to pay. It's not that you have to be in hospital to get NHS funding. It's available in other settings, but your needs must be similar to that in hospital. And you naturally have to have nursing staff involved in your care. There's two levels. There's a level where you just get a weekly contribution paid towards your nursing care, and there's a level where you get all of it paid for, and that's again quite commonly understood with palliative care or terminal care, but it's complex, it's difficult to get, it seems to be harder to get it, but you need to be aware of it. And of course some people qualify, otherwise it wouldn't exist, but it's certainly a little bit of a challenge, I would say. But it might be something that's not relevant at the start of you or your loved one's journey, but you do become eligible for this support later on, so that's why it is worth a mention. You then have the category of people who are self-funders, which, putting it simply, are people that have too much money for the means-tested state support, and they're not poorly enough to have the NHS funding made available to them. So they're the people who have to pay for it themselves. And my only really positive message for those people is that if you're getting it already, you can continue to claim and receive attendance allowance. If you haven't heard of it, then you need to make a claim. People think that when you move into a care home, this stops, or you're not eligible to have it, but attendance allowance is absolutely for self-funders who are, by definition, paying for their own care in a care home. A daily rate of, a weekly rate of either £68.10 at the moment or 101. These are going up by about 6.5% in April. The difference between the two rates is if you just need somebody to attend to you during the day, it's the lower. And if you need some nighttime assistance as well, and that could be 3 interventions or more than 20 minutes worth of support at night time, then you would get the higher rate. This switches off if you become state funded, because it's just sort of interdepartmental support otherwise, but absolutely carries on or can be claimed for self-funders in care. Now, the other and only other real state benefit or support for self-funders, and it does actually apply to an awful lot of people, is if there is a property that is not a disregarded property. Remember, I said if a spouse is living in there or a relative over 60 lives there, it's disregarded. So I'm not talking about that scenario. I'm talking about really somebody, perhaps a widowed individual, leaving the family home and moving into care, leaving that property temporarily at least vacant. For those people, they may get some state support. It's called a 12-week property disregard, and it's a really, really confusing rule. It sends people off down lots of different wrong pathways. I'm pretty sure most social workers are giving a lot of incorrect advice. Well, we know they're giving incorrect advice about this. Only applies, as I say, if the property's vacant, someone's moving into care on a permanent basis, and they meet the local authority's care eligibility criteria. So you've got to have that care needs assessment that I mentioned right at the very beginning. If you don't have that, you won't get this support. If the local authority don't think you need to go into care, you won't get this support. So there's a few hoops here. And actually, do you know what? A lot of families don't bother jumping through the hoops for what it's worth. They say, well, I know we're entitled to the 12-week disregard, won't bother trying to claim it. The idea of the disregard was just literally to give families some breathing space, to have 3 months to decide what to do with the property. Now, realistically, if they decided to sell it, they're not going to get it sold in 12 weeks, certainly not at the moment. So it's a little bit pointless. I personally think it was there to spin a yarn to the media at the time that this was introduced. So only for people moving into care permanently, leaving the property empty, and whose savings are under the threshold. So if you've got £50,000, you're not going to be eligible for this either. So under the 23, meet the eligibility criteria, then the local authority will pay for your care for 12 weeks. However, they will only pay at their local authority rate. So you as a self-funder have chosen a care home probably costing much more than that. You will still have to pay a top-up, and it can be an own person, a first-party top-up. But that you get the £700 or whatever it is from the local authority, minus the income, the pensions, maybe 300 or 400 a week you end up receiving for 12 weeks, and you do not have to give it back. So you decide whether it's worth jumping through those hoops. At the end of the 12 weeks, you probably haven't sold the house. You may not have decided what to do with it. And you may be thinking of that question I posed at the beginning, do I even have to sell? Well, potentially not. You might decide to rent the property out. You might decide that it's in an area to get good rentals, at least that's sort of narrowing the gap between the fees and the existing income. However, most of you might then decide, well, where would the rest of the money come from, because we would still be short. And this is where I'm going to lead on to something that does get mentioned by local authorities, but they seem to only mention this and not mention the 12-week disregard. So the disregard comes first, and then you can have a conversation about a loan from the local authority, because your sort of normal equity release type arrangements, you can't have an equity release mortgage on a vacant property. Someone's just moved into care, no lender will then give you a mortgage on that empty property. but the local authority will. The local authority will lend money on a property that's either for short-term cash flow that's going to be vacant for a while, or that you decide to rent out long-term. So all local authorities have to have a scheme for their citizens. They can charge interest on the loan, of course, but it will be lower than a mortgage rate. You still have to meet the care eligibility criteria. You have to have the assets under 23,250. But here, they don't have to restrict what they lend you. They can lend you as much as you need because they're going to get it back. If there's already a mortgage on the property, they won't lend. If it's a very low value property, they won't lend. If there's any structural issues with the property, they won't lend. But for some people, you can see where this might fit. It follows on from the 12-week disregard. As I say, 12-week disregard money doesn't have to be paid back. This loan does. Now, this will be very much, I've whistled through that. This will be a more detailed conversation with you to think about the pros and cons of renting a property out, how the loan scheme works and what the alternatives are. But I just wanted to flag it for today so that you don't automatically think I have to sell this property to fund mum's care during her lifetime. Actually, it could happen when mum's not with us anymore, potentially. And that does matter to some families, particularly, as I say, if mum or dad's very aware, they might not want to know or think that their property is being sold to pay for their care. So there might be a place for this. We can pick that up on a bespoke basis. So really, in closing, looking at self-funders as a sort of more global group, so not just with a house or not just with restricted savings. This could be people with a lot of wealth. This could be people with investments and so on. So all self-funders, when we chat to them, and we're normally talking to the sons, daughters, nieces, nephews, etc., usually acting as a power of attorney, when they ring us at the start of their journey, we're looking at care homes. You know, we've been quoted some care home fees, and we'd like to talk about how best to pay those care fees. They're sharing with us two main concerns. We don't have a crystal ball. The care homes told us what the weekly fee is, but because we haven't got a crystal ball, we don't know how long mum's going to be in the home. How on earth can we work out whether we can afford it or not? It's a valid question. And another valid question, we choose this care home because we love it. We're happy we can pay for it for at least a few years, but what happens if the money runs out? And that absolutely does happen. Particularly what happens with good care is somebody moves in, they settle, and guess what? They thrive. And their life expectancy often increases. So it is a legitimate concern to think about what looks like quite a big pot of money running out. And we're having conversations with families every day, really, to try, if we can, to alleviate those concerns. We are not always going to be able to make those concerns go away and give reassurances, but actually, in far more cases than you'd think, we might be able to offer a solution that would take away both those worries. It's a very unknown solution. Again, if we had the IT expertise to set up a poll on the webinar, we could do a vote right now and say how many of you know about this. The global poll that I've done over the years is that the solution I'm about to share with you, 85% of the people for whom it could work and be something that they would think was great and would take away those worries and concerns, 85% of them will go through this entire care journey never hearing about it. It's a financial product. It's designed only for people worried about money running out, paying care fees. So nobody else can have it. It's just for that very niche group of people paying care fees at home or in a care home who are worried about the money running out and want to prevent that happening. 85% of them never get to hear about it. And going back to my family, that's what we didn't know. No one told us about this, and it would have worked brilliantly for my granddad. So if nothing else, as you sign off from this event in about 10 minutes time, if you're still with me now, you will be in the 15%. And the recorded webinar that you get, by all means, share that with other people in a similar situation so that they're in the 15%, not the 85%. So what am I talking about? There must be 15% of you on the call that perhaps have heard of it, but it is a way of putting a cap. You know, we've heard about the lifetime cap maybe not happening, the government one. Take action yourself if you want. You can cap costs yourself. You can actually insure care home fees. Now, some people don't like the word insurance, and I'm possibly with you on that. I'm using the word insurance because it's familiar. So people kind of get the concept of it, that another company, an insurance company, is taking the risk. You can insure care home fees, but you can't do it in advance. And that's a bit weird, isn't it? Because the sort of insurance we're familiar with, car insurance, house insurance, you have to buy it before you need it. With care home fee insurance, you can no longer buy it before you need it. Those policies have stopped being manufactured. You can only buy it at the time, at the point of need. Okay. Now, the technical Google search engine, if you want to do any of your own research, use the research term care fees annuity, because that is the technical term. But even then, when we use that word, people, even in my industry, accountants, bank managers, will say, oh, annuities, they're expensive, they're poor value. And I'm sort of with them as well, but they're probably referring to retirement annuities or pension annuities. So there's similarities and there's differences. The difference is that a retirement annuity would normally be purchased by somebody in their maybe 60s, maybe early 70s. So it's going to be paying out for maybe 20 or 30 years. So in that context, the insurance company is going to want quite a big lump sum, or going to provide quite a small income if they've got to pay it for 30 years. You might want a spouse's pension attached. You might want it index linked. So you save up into this pension for all your working life. It looks like a big amount. You hand it over and swap it for an income, for an annuity, and it suddenly doesn't feel very good value. But that's why. With a care home fee annuity, these people are typically mid-90s nowadays. Actually, I think our average client age now is about 89, 90. So they are not expected to have the money be paid out for 20 or 30 years. May only be expected to pay out 4 or 5 years, something like that. Again, you have to be really careful here with averages. There's a statistic somewhere about average stay in a Bupa care home is 2 years. Well, you know, Bupa care homes, that was a survey from something like 14 years ago. They had a lot of nursing homes, so a lot of people going in for end of life care, etc. I know just from working with B&M Care for so many years, they have residents living there an awful lot longer than 2 years. So be really careful of averages. But the idea with the care fees annuity is it's not going to pay out for as long as a pension annuity, so it's much better value. So in that, and it does take into account somebody's health and care needs. So the similarity is you are swapping a lump sum, giving it to an insurance company, and getting an income for life. The income from a care fees annuity is tax-free. The difference, again, though, is every single one of these is individually underwritten. So it does take into account that person's age, that person's care requirements, that person's GP records. It's not a rate table that's generic. So again, when people say, well, how much would one of these cost? I can give an idea just based on experience, but it does need to go through the underwriting process to get an accurate offer, a quote that you could actually take up if you wanted to. It doesn't, none of this underwriting involves mum or dad or auntie or uncle. It's all done behind the scenes with a sort of telephone interview with the care home, getting hold of a copy of the GP notes and any information that the family want to provide, but it's not intrusive. Mum, dad, auntie, uncle, not involved at all. So if I have a room of 10 85-year-olds, and they all need an extra £50,000 a year to top up their pensions, to meet their care home fees, the quotes that I get will be different for every single person sitting in that room. So when we are, or we sound evasive that we don't know how much it will cost, this is why, because a lot shows up on a doctor's report, a lot shows up with a chat with the care home, and that is all factored in when the insurance company underwriters look at this. Now, once somebody has got the quotes, they come to us, we're the intermediary, we go to the whole of market, we get all the quotes that are available, we then put that into an advice report for the family, we work out how much is needed, we look at the different ways the plan could be set up, and we write this advice report that starts to answer all the questions that you might be formulating now, such as, can it move? What if mum or dad moves care homes? The answer will be in the report, and it says, yes, it's fully portable. It will look at what happens if care home fees go up. It will give the cost of an annuity with a built-in increase, but it will also look at what happens if you don't include that. So lots of useful information, and it compares it with the route that you might be on at the moment. You might be on a pay-as-you-go route. You might be thinking about investing the money. It will compare this product, this care fees annuity product, with those alternatives. So you can make a really informed decision as a family. Now, if it isn't apparent already, with insurance, there's always a downside, right? it's a gamble. This product is a gamble around somebody's life expectancy. The insurance company will offer terms. You might buy and accept those terms. But if your loved one dies much sooner than the insurance company had predicted, the default position is there's not any money returned after the first 6 months. So the estate could make quite a big loss. The flip, of course, is that your loved one lives much longer than the insurance company predicted. The insurance company has to pay for life, even if that means paying out twice as much as you paid for the policy in the first place. You know, that's the gamble. But, you know, not having an annuity at all and just paying year by year from savings, that carries its own risk, doesn't it? It carries the risk of the money running out. A care fees annuity, the money will never run out, but you might make a loss in those early years. So it's trying to sort of understand the risk of both routes, pay as you go versus insurance. You can sometimes mix and match. We have had families that do use investment strategies, pay as you go for some of the shortfall and use the insurance annuity for the other part. This is our job to guide you through. Now, I said about the gamble, there are ways to try and reduce that exposure, to try and mitigate the gamble, make it not so risky. And that might be by including some extra capital protection, which we get quotes for, or buying the policy with a delayed start date. So it's a bit like having a voluntary excess on your insurance policy. You pay a bit more, the insurance company's price goes down. So with the deferred option, you still buy it today, but you say to the insurer, you know, don't worry, don't pay anything to the care home for the first year or for the first 2 years, we'll cover it, and then we want you to start paying out. Well, of course, the insurance company will charge you much less because they haven't got to pay anything out for the first year or two. So you're putting less money in the hands of the insurance company, so you're losing less in the event of early death. So that's a really sensible, in my opinion, way of striking the balance. You still have the longevity risk covered, but you're not risking as much money up front. So we always look at those options and the others mentioned there and wrap everything up in this advice report for you. We'll also make sure you understand these are properly protected products. If something goes wrong, the insurance company goes bust, you are protected by the Financial Services Compensation Scheme, 100% of the income. Okay, so it's not the 85,000 cut-off point that you would have with money in the bank. If you've bought a £50,000 a year income, that's what's protected until the person dies. Okay, really important to know. So you can kind of get a feel for where this might fit. Some people buy these policies because they want to know what the cost is up front. They want to know that the remaining estate money is ring-fenced and will never need to be used for care, no matter how long mum or dad or auntie or uncle's in the care home. Some people do it for that reason purely. What's becoming much more of a factor is people buying this type of policy so that they never have to knock on the door of social services, because it feels like the entry point is becoming higher. It feels more risky. It feels like the local authority in years to come are going to refuse funding for more people than they are now, just the way that the money in the budgets are working. So by having a care fees annuity in place, knowing that you can fully self-fund forever, no matter how long the stay in care is, that is giving people a lot of comfort around not ever having to worry about involving social services. You also need to know that in the rare event of buying one of these and then not needing it anymore, and the most common scenario for that would be if you later on qualified for NHS funding, you don't lose the income. The income still pays to the individual, but it is then taxed. Okay, it's only tax-free if it's paid directly to the care provider. Because as I explained earlier, to do with our business model, the fact that we're not having to sort of factor in travel time and time on the road, we're doing things in a very streamlined, efficient way. Remember, we do this all day, every day, and nothing but this. We're not fitting your inquiry in amongst a pensions report or looking at somebody's complex tax matters. We are doing nothing but advising on this product and the appropriateness for you. So we're really, really streamlined. We're very good at what we do, and we don't waste people's time going through that whole underwriting process, giving you false hope if it's clear from the initial chat that it's not going to work or that alternative funding ought to be claimed. Okay, so we know what we're doing, we won't waste your time, and because we have this efficient model, we don't have to charge you for researching this option for you. So you can go all the way through to that initial chat, get some pointers from us, get an idea of cost, get us to go to the market, get that report, that advice report, do all of that, and actually say, no, we couldn't agree, the family don't want to do it, we're going to carry on as we are, and you haven't had to pay anything for that. The flip side is, of course, we're a business, we're not a charity, so we will need to be paid for people that purchase. So we have an arrangement fee built into the cost of the annuity when purchases are made. And that arrangement fee might be slightly higher than you would get with a different model, a model that charges you for the research and then charges you for the report and then charges you for buying. Okay, but you don't know that you're actually going to end up buying. So what we've learned over the years is that comfort of being able to walk away, no charge, no cost if you don't proceed, means it's worth potentially paying that slightly higher fee if the purchase is made. But we'll give you our explicit client agreement. If it doesn't work for you, don't use us. But it does seem to work for clients, and they appreciate that you sort of get what you pay for. Now, there's only 4 insurance companies out there in the market. A few years back, going only back 5 years, there were only 2. Legal and General and National Friendly have only come onto the market in the last few years. They actually used Eldercare to pilot and launch their product with. So we had an exclusive with these 2 companies for about a year. All I'm going to say there is we continue to have very good relationships with all 4 of these insurers because we do nothing but place business with them. So if there is a discount to be gained for a client, we will gain that discount for you. And again, that's another benefit for using a specialist like us. And it may more than offset our arrangement fee in any event. What I would say is, if this is something you chose to research, please do not ask multi-brokers to go and get the quotes for you, because we all have to go to the same 4. The same 4 use the same medical information, the same care home interview. All it does is duplicate the work, give the care home 2 years to complete instead of 1, saying the same thing. It achieves nothing. So if you're going to do your due diligence, which you absolutely should do your due diligence, it's hard to say, on the person you are asking to give the advice. It's the advice that sits around the product that's key. Okay, so you've got to make sure that they're SOLLA accredited as a minimum, and absolutely clearly and easily found on the FCA register. But then I think delve a little bit deeper and look at client feedback. We collect ours on Trustpilot because that's independently verified. And those need to be reviews about care fee funding advice, not pensions advice, not mortgage advice, not investment advice, not had a nice generic chat about financial planning. You need to see testimonials from people that have taken care fee annuity advice. That's my recommendation to you. Once you've satisfied yourself that you've picked the specialist, you know that they know what they're talking about, then that's when you instruct just that one to go to the market and get the quotes for you. Now, I've landed in closing on our website. I mentioned I'd give you our free phone number. That's on our website, 0800 082 1155. My team, Sarah, Tracy, Roger, Mike, myself, all equally knowledgeable, all been doing this for a very long time. You may prefer in the first instance, again, particularly with the volume of people we've had on this event, we had nearly 200 registering. It might be that emailing questions and us being able to work through them methodically could be better than sort of hitting the phones all at once. So advice@eldercaregroup.co.uk, an outline of your scenario. We can do our best to help. What you might find useful is on the care fees annuity page of our website, we've developed an online calculator where it says request a care fee annuity quote. You don't have to put in much information. You put in the individual's age. The calculator only works for people over the age of 80. People under 80 can have a quote, but it's not reliable enough data on this online calculator. You'd have to sort of phone and chat through the parameters, but it's a bit more reliable for the over 80s. Put person's age, what the care fees are, what guaranteed income they have, so it can work out the gap. And it will give you a ballpark figure, what we would expect a basic care fees annuity to cost before the medical underwriting is done. You have to appreciate that figure will change once the underwriting is done. But if you just want that, please just give me a feel, just give me an idea. Are we talking 100,000? Are we talking 300,000? That online calculator may be helpful for you. Lots of other information on there as well, about care funding and news events and so on and so forth. But hopefully that's been a useful summary for you. If I sort of look back to the agenda points, we've covered who pays for the care. Most people, it will be you pay for it yourself. Some people funded by the NHS if their healthcare needs say so. Otherwise, a few people funded by the local authority, and we talked a lot about the entry point to getting that. We talked about the care cap, that it may or may not happen, and even if it does, it's not going to benefit as many people as thought might benefit. And then really we touched on the family home, a particular bit of support that might be available for some people from the local authority so that the house does not have to be sold. And then we closed really with the idea of a care fees annuity to put your own cap on care costs. Okay, so yeah, that's hopefully all of those agenda points covered, and you've got our contact details there. As I say, if you've got questions, just because of the timing and the volume of people on here, you've got Angela at B&M's contact details for anything related to B&M Care and their homes, etc. And then you've got my details or my company's details on the screen if you have questions specifically about the funding more generally. And the recording will be with you either later this afternoon or tomorrow morning at the latest. So I will stop sharing. And thank you all on behalf of myself and Angela for bearing with, and I'll close the event. Thanks very much.